We're actually winging it a bit this morning because
fine.
American Airlines lost my luggage.
Oh, that sucks.
Yeah.
Like it's probably in Phnom Penh, Cambodia right now.
It's in Cincinnati.
Oh, that's good.
So I was rushing this morning. I had to go up to Bloomingdale's and get new clothes.
Yeah, yeah. So they'll get it to you tomorrow, I guess, right?
Later today.
That's good. Yeah.
I wanted to be smart for you.
I never check luggage.
Ever.
Because you're never going to see it again.
Problem is I'm out here for 2 months, so I've got a lot of luggage.
Yeah, I bet. Yeah, that's a problem.
So nice to meet you, man.
Yeah.
It's great to get you on the #1 Bitcoin show.
Absolutely.
Pomp will be a bit jealous.
Yeah, I'll tell him right away.
I got a bunch of things I want to talk to you about.
Let's go.
Because I'm not sure if you're a Bitcoin guy or just like a guy hunting for yield and making money. I know you've invested a bit in mining. I know you're on the verge of interest, but I don't know if you like really care like the crazy Bitcoiners.
You know, I would say that I'm viewing it now. Think about me as an investor. I have a mandate to deploy capital. And generally, I work in the world of 11 sectors in the S&P 500. And I'm trying to beat the index, both here and in Europe and in Asia, by investing in companies, either in their debt or their equity. So for a long time, crypto was interesting, but it wasn't where institutions were going. And I serve the institutional and market and the foreign, pension plans and sovereign funds. And I talk to them every day. And so what I'm interested in doing is understanding where they're going, because I'm a service entity for them. I index. So they say, look, I want to index psychedelics. MindMed is one of my companies. Now there's 3 others, and they've raised billions of dollars, and we're going into the exploration of psychedelics as medicine, not as recreational drugs, FDA approved, et cetera. So what's interesting now about crypto, I don't consider crypto Bitcoin or Ethereum. Okay, yes, they were the pioneering assets, but I'm considering crypto as the 12th sector of the S&P. It hasn't been declared that yet, but I think that's where we're going. And so when you talk about running a mandate like I do for institutional clients or institutional mindset, they say to themselves, okay, in a normal world where I understand each of the 11 sectors of the S&P, I may allocate the largest I would allocate would be 20%, let's say, to technology. That's generally the max in a mandate. And maybe you do 3% in energy because your ESG concerns are there and all the rest of it. But you're dabbling in all 11. I'm now dabbling in crypto as if it was the 12th. So that means I don't need a mandate to do that. I'm doing that because I'm able to get my compliance department to agree on certain coins, tokens, assets, but they have no interest in just buying Bitcoin. I get Bitcoin. That's one asset. It's just like when you say, I'm going to have 20% in tech. There's 1,000 companies to choose from to build that position. So for me now, to actually get into crypto, I need multiple positions because I'm mandated to have diversification. So yeah, I own Bitcoin. Yes, I have some Ethereum. I have some Litecoin. I have some USDC, but there's much more coming. And I'm at 3% right now, waiting in a mandate. That's not a lot. I'm on my way to 7% by year end. That's a lot. And that's starting to be where I consider myself a participant in this market. But I'm having to do it different than maybe you or Pomp or a lot of the guys that were pioneers. I don't have the option to be a cowboy. I can't do that. I have 3 problems on that front. Number 1, I have to get my internal compliance officer to agree. Number 2, I have to get my external auditor to sign the audited statements that then turn into reports to the regulators in every jurisdiction that I participate in. I cannot afford to be offside for 1 second. So that's taken a lot of time. That ain't easy. And that is where we sit. And I'd say to you, that's good and bad news. It's good news that I've been able to do it. It took me almost half a year. But the upside is that there's trillions of dollars of the people I service that want to do the same thing. If we could just get the regulator on side to tell us what the rules are, it's like football. You can't play football if you don't know the rules. We need the rules. Then you're going to get a massive allocation to crypto.
What is 7% in real numbers?
I don't say, because it goes across multiple mandates. And, we have rules about disclosing dollars because it's not always our money.
And are these people just kind of aware that this is this crypto thing and they know they should do it and they just trust you with your money. Because in my world, like my show is what Bitcoin did. I 95 to 98% of our content is Bitcoin. We occasionally discuss other projects. So I might discuss Ethereum if I wanted to talk about stable coins or do the comparisons. But in my world, Bitcoin is very different from crypto. I actually consider them two different things. All they share is the fact that they both use a blockchain and cryptography.
Yeah.
But what they are trying to achieve, for me, are very, very different things. So is there just this wider desire for people to invest in crypto and they don't really care what it is, and it's for you to decide the investments?
No. When it comes to crypto, because of the compliant and the regulations and where we're at, I don't put other people's money into crypto mandates. I'm very fortunate to have my own operating companies, multiple operating companies that I control in the case where this crypto is 100% control. So I am allowed, but I have to be compliant anyways, because when you have a compliance department, it's because you've been able to grow business. I have multiple investments in financial services companies, many of them which are reporting and regulated. So I can't be offside. It's because I'm a shareholder in these companies. And so—
What do you mean by offside?
So let me give you an example. Back in 2017, when I took my first position in crypto, the regulatory environment was nothing less than toxic, all right? At that time, regulators around the world were sending out complaints to all kinds of people that were trying to tokenize all kinds of assets, including one here in New York, a hotel. It was a poop show. And
you can say a shit show.
Yeah, it was, and you just can't get involved in that when you're reporting and being compliant in many other jurisdictions. And so at that point, I was just, my own compliance department said, you got to stop talking about this stuff. You got to stay away from this stuff. This is just an environment that is brutal. Over time, in particularly the last 24 months, you've seen Switzerland, Germany, France, England, Canada, a jurisdiction that cooperates with regulators in the US in total harmony, launch ETFs with their primary asset being Ethereum and Bitcoin. So the tonality of that regulatory environment has changed dramatically. You're starting to see the regulator, talking about, let's discuss these asset classes, let's get into a dialogue about it. And as a result, I've been able to be more flexible about my own position and come out and disclose just a few months ago that I'd taken on a 3% position in our operating company of specifically Bitcoin and a few others. But I agree with you on the thesis you have on Bitcoin, because when I talk to— let me give you an example, which is, I think, is very intuitive what you said there. Mm-hmm. Let's say I'm talking to a sovereign fund, all right? Let's say, and they have $500 billion, and they want to deploy into crypto for the first time, and they're going to put a small weighting, 1%. The reason they haven't done it yet is not because they're having a debate about whether they want to. They want to. But they have a compliance department that includes an ESG committee, which determines which assets get to the investment committee first, because every single asset is viewed with that particular sovereign fund by the merits of sustainability. And so just at Bitcoin 2021, there was a huge debate going on. Elon Musk was involved. I'd made some statements about it because I'd learned from the pensions that they weren't going to get involved in it because it was not ESG compliant. The Chinese were burning coal to make electricity, to mine and get awarded coins. That was a nightmare. And so the reason Bitcoin is still not yet an institutional product is we have not got around this issue of sustainability. It's getting addressed, and I'll give you an example. This is a shout out to a company I am a shareholder in, Hut 8, all right? Jamie Leverton.
Yeah, she's great.
She is great. I met her through a real estate transaction, and we started having a discussion like you and I are right now about ESG. She said, look, I'm ESG compliant. But what I like about her company is that I can buy her equity, which I did at that time. I think I'm up 69% in the mandate that's in, because she claimed, and she was right, that she is in direct vol. In other words, the correlation between the price of Bitcoin and her stock price is 1-to-1. So she is keeping every awarded coin on her balance sheet. She doesn't sell it. She loans it out to get fiat and pay her expenses. And as a result, she's a proxy for Bitcoin in a compliant way that many of us can invest in. So the model for her, and I talk to her about this all the time, is don't go buying assets that are not ESG compliant. If you continue to mine on an ESG compliant basis and you're a woman and you have women management, because a lot of these sovereign funds demand compliance around diversification. I'm talking where there's billions of dollars, not, buying $1,000 worth of Bitcoin, where they want to allocate huge dollars. Her model is going to be the model of the future for miners, which is why I made my biggest bet with her. Every time she looks at a new mining operation, it's got to be 100% ESG. That means it's going to push her to solar, it's going to push her to wind, it's going to push her to any compliant way, maybe burn off of gas and use it productively as she does in northern Alberta. But Bitcoin to me as that asset class is not a currency, it is an asset, because the plans I'm talking about, the sovereign funds, they want to buy the coin and never sell it, never trade it. So if they felt that they could buy her stock, for example, and know that she would, guarantee them that she would only mine new awards sustainably and she never would sell the assets, they may consider that as their proxy for Bitcoin, which is, I think, a big opportunity for them and other miners as well. So I talk to all the miners all the time. They're always soliciting funds, and I get it. But I can't ever be, because when I disclosed that I had 3% weighting in Bitcoin and Ethereum, the first call I got were from all the guys that I know in the pension plans saying, do you know that those are sustainable or not? Do we own them or just you? Because we can't own them. And that's when I learned about the problem. And it remains today, and the reason I say it's not a problem, it's an opportunity, if we solve this in the Bitcoin asset community, whatever you want to call it, you're going to see $1 trillion worth of fiat currencies go into Bitcoin as an asset, just like real estate. And I think you want to talk about $100,000, $200,000, $250,000 coin price, it has to solve this problem. It won't get there till then.
I haven't actually discussed, we haven't done ESG yet, have we, on the show? Marty Bent did an interesting show with Michael Saylor discussing it. And one of the funny things I find about ESG is 95% of the conversation seems to be about the E, not the S and the G. And you must know Dan Moorhead at Pantera.
Sure.
Yeah. Did you read the Pantera thesis where they covered why actually?
I have read it.
The E,
I have read
the
it.
social and governance. Bitcoin's actually a great tool for social and governance.
It is, but here's the delta between the thesis of that, call it a white paper if you wish, and then the reality is, when you meet an ESG committee, okay, that's sitting on top of the investment committee of any institution, and they even have ethics committees now because they don't want to invest in places where human rights are abused. There's all kinds of these filters coming in. You can have a discussion about how many fairies dance on the head of a pin with an ESG committee, but it doesn't matter if they don't agree. And so what they want to know is, are hydrocarbons being burnt in the creation of the energy used to get a coin awarded, all right? Yes or no. Binary, yes or no. And you can't give them the theory about how it's good that there's more efficiency being built into the models for miners and their stacks and efficiencies and all that stuff. They don't give a shit. What they want to know, are you burning any hydrocarbons? If your answer is, oh, well, sort of, kind of, sort of, they just can't invest.
But we're a long way off at zero.
Well, I think what we're going to need to get, because my thesis of owning coin now is, I do believe over time we're going to solve this problem with the idea that miners, the next generation of miners, are going to say, look, they'll go to the ESG committees first and say, I'm going to put up a gig, all right, of mining capacity. I'm going to put it up in West Texas. I'm going to use solar and wind when it becomes available. And I'll build it out 250, at a time. And I want you to give me 150 million, and I'll give you equity in my operation. That's coming. And that way, and the investment committee says, what is this, an infrastructure deal? And that's what it is. If you can show that you can get 11 to 17% annualized return, which you could if you believed in Bitcoin, you would write that check for $500, $600 million. That's the snack bracket of these funds. But they can't do it unless it's compliant with ESG.
Where's the ESG pressure coming from? Is it just themselves as a
I think you can blame Larry Fink's letter each year. And I think he's a genius because he sets the mandate for the global consideration at the board level of ESG.
You should probably explain who Larry Fink is.
Well, the largest asset manager on earth is BlackRock. And he writes a letter each year, and he sends it to every CEO of a company he's invested in. And it basically sets the rules by which they should govern their companies regarding sustainability and climate change and all kinds of other issues that Larry believes in. Now, you can ignore it at your peril, because if he puts a position on in your company, he's going to be one of the largest shareholders, period. And so he's on a mission, and I think it's a noble one. He himself has to struggle with the definition of what ESG is, but he has changed the tonality of the S&P 500 in just 36 months. And the reason, and I'll give you an example how you can test this thesis. You look at the price-earnings ratios of the entire energy sector. They have been going down, even though earnings have been going up since he started this thing. He started saying, we don't want to mine oil out of the ground. We don't want to transport these hydrocarbons. We want to get rid of them and find a sustainable method for energy. And that whole sector got crushed, and it continues to underperform. Why? Because the incremental buyer, the institution that is, also reading that letter says, Chevron, no thanks. Basically, we don't want it. I've been in the same pressure to remove those names from some of the indices that I'm involved in. And I love energy. I think it should have a place. And these companies are spending billions to come cleaner, and they're incentivized to do it. It doesn't matter. Their price-earnings ratios are getting crushed. So going right back to the beginning of your question, that's what happened. And it's global. It's global. So he will basically set a tone that disfavors non-sustainable companies and favors those that are sustainable, and they're rewarded with higher price-earnings ratios. Same thing for Bitcoin. It will have a higher PE when you can say that coin was mined sustainably. And I think that's why we're talking about these massive new opportunities.
I mean, there'll be two types of people who will listen to this. There'll be somebody, I think, like a Michael Saylor, who will agree with you. And I think he considers Bitcoin as more of an investment, a sensible investment, a place to store his money, and a moonshot to become one of the richest people in the world. But there's that kind of person. But there's also the kind of person like Marty Bent, who debated him, said, I don't care about these people. Bitcoin can take its time. We don't need an acceleration in growth. They come more from a moral standpoint about having good, sound money and censorship-resistant money for people in all difficult locations around the world. And so he feels like any kind of compliance with ESG is bending the knee to someone else's narrative. And it's two very distinct crowds. And I'm sure you're aware, like, there are sub-communities in Bitcoin.
Oh, my goodness.
Some are quite radical. And they're just like, I don't give a fuck about these people, excuse my language, but they don't.
And believe me, I hear from those constituencies too. My point is, I live in the real world. So if you're an owner of Bitcoin and you want to see $100,000 price on that coin in the near future, you have to address this issue. And I'm sorry, because even for all the excitement, at a conference like this and the discussion we're having of Bitcoin, I bet you no more than 4% of institutions globally even touch it. They don't give a shit. They're not going to. And so my opportunity, the way I look at it, is they say, well, if I can be part of the solution and I'm going to invest in miners that are part of the solution, I'm going to be rewarded because I'm solving for trillions of dollars that want to play that won't. They don't care what the radical, I love, the community. I get it. And I hear this debate every day. But then I go back into my office and I look at my board, and I look at trillions of dollars of institutional money flowing around in assets that have been approved for decades, and none of it's Bitcoin. None of it. And Fink said the same thing just 3 months ago. He said, we don't give a shit about Bitcoin. He didn't say that. He just said, nobody asked us about it because no one's going to buy it. The thing's not ESG compliant. Bingo. That's the opportunity. He just set the rules.
Yeah, I mean, that's a danger in Bitcoin. I mean, when you say radical, so others would say principled. And
I love principled, yeah. But radical principled. One man's freedom fighter is another man's terrorist. It's the same thing.
Yeah, but the principles of what's happened with Bitcoin, how it's been built, has been built around quite solid principles. And some of these people will say, well, who is this Larry guy? Do we need him? Who cares? If the institutions don't want it, fine. Michael Saylor can have it. Elon Musk can have it. They'll come eventually.
Why did Musk do a 180 turn on taking coin for the purchase of his vehicles? I'll tell you why. This is my speculation, okay?
I'll tell you mine if it's different.
All right, let's see. So he makes his decision. He goes out there. His majority of his investors in Tesla are institutions now. That is an institutional company. Mm-hmm. And he's been rewarded a very high PE because they believe in his vision for the future. Along comes this idea to pay for your Tesla in Bitcoin. All of those institutions have ESG committees. 99% of them are on the sustainability model. They know that there's a debate going on regarding coin and the mining of it in China, non-compliant ethics issues, ESG issues, burning coal to make coin. They just called them up and said, no fucking way. You know, we invested in Tesla, not this debate about ESG. That's my thesis.
Yeah, I think you're probably right. And I suspected there was also probably some internal dialogue, a little bit like when Spotify took Rogan. There was these internal debates about some of the shows and guests he had, and 20 shows were censored. I have a feeling he fought a bit of an internal battle over that one as well. But the problem with that, Kevin, is that I would rather Elon Musk just sold his coins. And I'm sitting in the field of people who say, look, I would love 100,000 Bitcoin, but at what cost? Am I here for $100,000 Bitcoin because it makes me wealthy? Or am I here because there is a currency now that I've just been down to El Salvador again for like my 5th time, and I've seen the difference it's making to people's lives there. Or am I here for that? Therefore, do we risk Bitcoin? Do we risk centralizing it? Do we risk destroying what it is by bending the knees for the investors? And that's what I don't know, and I do wrestle with that.
Yeah, I think it's a great debate, but I don't think Bitcoin's ever going to be centralized. It's going to be regulated, but never centralized. And I think to the fact that, as we started this dialogue earlier, I, like you, believe in it as an asset. I own it. I've never traded it. I'm never going to sell my coin. It's to me, it's the building I used to own in Boston that I sold for cash. I mean, it's sort of, you know, it's something that I think over time will beat the indices and hedge me against inflation. It's similar to gold, which I also own, but maybe in a better performing way. And I need to get all the roadblocks out of its way. I don't want to have this ESG debate about it anymore. And I'm part of that debate. I'm one of the voices that have been saying this now for 2 years. We got to address this issue. And again, it came up at the panel I was on today. It's the same story. In that audience, every time I come to these conferences and I do a panel, I look into the audience and I see the same institutions that I serve indexing with baseball hats on, and sunglasses. They don't want to be seen here. They don't want to be seen here, but they're really interested in this asset class. And in that room, I bet you 20% of the people today, I don't know, there are 3,000 people in there, are involved in financial services. You can tell who they are because they're wearing a hat and they got sunglasses on, because they're not ready to declare they're players yet, but they want to figure out what are the rules and when will the regulator approve it, because it will be allocated. And I think when you're talking about $500 billion sovereign fund and they allocate 1%, you're talking real money. Mm-hmm. And you as an owner of a coin are going to vastly be worth a lot more than before their participation. So what we can have this debate about the community and, you know, moral obligations and centralization, decentralization. But if you were able to get the institutions just a 1% allocation, that's $1 trillion worth of buying. So now you're talking about $1 million Bitcoin. That's why I'm in the game. And so I'm happy to have this dialogue saying, everybody wake up and understand, smell the fucking roses. It's there. The opportunity's there. You got to get on the bandwagon to solve this problem for them.
And how much issue is there with the regulators right now? Because, again, I can reflect on El Salvador, and we just see today that President Bukele announced that anyone invests in the country, they won't have to pay any capital gains tax on their Bitcoin investments. And they just move really quickly as a country. They just make decisions, they move. And we've just seen Ukraine has announced that it's legal to own Bitcoin, and it perhaps might become the next one. And we're seeing these smaller nation dominoes falling. Yet here we are in the US, where the majority of Bitcoin companies are. I expect the majority of Bitcoin wealth is. Yet it seems like the regulators are doing everything to hold it back.
Yeah, No, it's a great observation. Let me give you the answer from the pragmatic view of the big guys, okay? The guys I get to talk to all the time. Here's the way they look at it. Let's say you're running, I don't know, 100 billion, all right? And your job is to work with your compliance department, work with your auditing teams, and then of course report to the regulator in the jurisdiction you're in. Same thing all around the world. For 100 years, those mandates have had the compliance infrastructure. So let me give you an example. Here in New York, some guy running $1 billion mandate right now, at 4:01 or a second after 4 o'clock, the systems will mark to market every position he has or her and it'll go straight to the compliance department and they will see every single position. And they have the AI to automate it. Let's say the mandate is you can't have more than 20% in any one sector of the S&P and you can't have more than 5% in any one position. That's a classic mandate, okay? If they go offside, even for a second during the trading day, the lights light up in the compliance department because it's a mark to market by the second, because they have margin on there sometimes. So whether they buy a bond or whether they buy a stock or a future or whatever it is, those systems are infrastructure inside. And at 4:01, the compliance department checks the box, says everything's cool, all right? Then what happens is the auditor, the external auditor, can at any time go and check that they're compliant, because at the end of the quarter, they're going to be asked to sign off on the statements as an independent auditor. And those signed off statements then go through the reporting systems to the regulator. Now that infrastructure exists everywhere, in Switzerland, in Germany, in France. That does not exist anywhere for crypto. There is no infrastructure inside of that institution to deal with, okay, I'm going to buy $10 million of USDC, and I'm going to write contracts for 30, 60, and 90 days on a loan. I'm going to pull in 5.5% interest paid back in USD, and I go back to fiat. You can do that with, Circle if you wished. There is no infrastructure to do that.
Who operates that structure within the traditional markets?
So what happens is, if you're a XYZ fund company and you are managing money for institutions like a university or a state, they won't give you a dime until their compliance people go see your system and that you're 100% compliant and you're able to report to them. What's missing in the crypto universe right now is the investment in compliance infrastructure, so that I'll give you my example. In my own operating company where I have to be compliant, I say, look, we just sold that commercial real estate. We've got a lot of cash. Our cash desk says we can only make 21 basis points. I'm going to buy a few $1 million. Let's just start with that. Let's just start with a small amount in the mandate, and I'll show you how it works with USDC. The one I like. I like the USDC. I don't do Tether. I don't do DAI. I use USDC because I love the compliance that's being built over there at Circle. And my compliance officer said, no, we are not doing that. I said, why not? Because how are we going to report that? We have no way to market that. How do we know? It's hybrid. It's risky. The answer is no. The answer is no. The answer is no. And I said, no, we got to solve this. We're not beating inflation on the cash we just brought into the operation. We just sold real estate, and now in our mandate, we're losing money every month because we're getting 21 basis points and inflation's 2%. And my own compliance officer, that I pay that person, I pay them, but they're arm's length from me, said, no, not doing it. I said, well, I'm going to call the auditor. I call my own auditor, and they said, no, not a chance. Are you out of your mind? We're never going to sign those statements. It took me 6 months to just do the first $1 million. I mean, just to get that as an experiment, to just show them it can be done, because there's no infrastructure. And so it's very easy for you and I to just open up a wallet and buy stuff. But if you want to play with the big boys, you got to solve this problem. And so that's the noise I'm making. I said it on the panel today. Jeremy was there. Sam was there from FTX. And I got to disclose I'm a spokesperson for FTX and an investor with him now. And so the reason I did that is I want to use his infrastructure for compliance. He's got the biggest global infrastructure ever. And he can be compliant with my own auditors and my regulators in the various countries I operate in. So, I look at this as a huge opportunity, but everybody thinks it's ready to go. It's not ready to go. There's much work to be done to make it so that some guy running 100 billion says, okay, put 10 billion into DAI or put it into USDC just for the overnight, and not have a red light blow up in the compliance department saying, what the hell is that? What is that thing? You're non-compliant, like the phones. Yeah. And the army runs down to his office and shoots him. Like, think about that. That's what happened today. And so that's what we're trying to solve for. And a lot of people don't understand that opportunity. To me, it's an opportunity. And so when I see these companies emerging, I think we're at 29 billion of USDC now. So there's people playing in it. But 29 billion sounds like a lot of money. It's nothing. It's nothing in the global context.
I mean, I think it's quite a lot.
I know, but trust me, it's not. It's not. It makes people think, oh, the institutions are involved. No, they're not.
Yeah. Let me ask you something, because you talked about in that last moment, you talked about beating inflation. And what inflation number do people like you use? Because we see quoted government inflation, which is around 4 or 5%.
Yeah.
We see house prices shooting up. I speak to my friends who work in traditional trades, plumbing, carpentry. They're saying their prices are up 10, 15%. Yeah, the house I wanted to buy, that I nearly bought last year, I think it's up 20%. What numbers do you guys use for inflation?
Yeah, it's a great question, because you've nailed it there. You've talked about sectoral inflation, and so there's input costs going up in many sectors. But real estate for a while, and lumber was going through the roof, and certain commodities were spiking. But right now, I think the way I look at it, when we have a very large cash position in my operating company, because we reduced our commercial real estate over the last 2 years from 31% down to 8%. So I have to redeploy that. You don't do that overnight. Mm-hmm. So we're going to take crypto up to 7% from 3%. So we're going to be working on probably 17 to 20 positions in different coin, different token, different chains. We're doing that research now.
Why did you reduce your real estate position so much?
I'm a real estate guy from way back, and I've lived through 3 cycles in real estate. And you look at cap rates, and so when you see AAA Boston or New York trading in under 3.5 cap rate, or under 4 even, you're at the top. Now, right. You don't know how long you're at the top, but you're at the top, because cap rates are crazy, crazy, crazy low in those markets. And the risk you have is, if interest rates go up, so do cap rates. And so you can lose 20% real fast. And so, that was one situation. And I also saw what was happening in I've got investments in about 34 private companies. I've got commercial kitchens. I've got wireless charging. I've got insecticides. I've got beach chairs. I've got, you name it. I do FTX, not FTX, but PRX gym equipment. I mean, these are companies that are really successful. And I watched what happened during the pandemic, and I saw that, I asked them in Q3 last year, what's your estimate for use of corporate real estate for back office and for retail? Because in situations where I have a control position, I want to know what our CapEx is for next year. So back then, we made the assumption, you may find this really interesting, because I was stunned, that 15% of our staff would not come back to the office after pandemic, and specifically in the areas of departments of compliance, accounting, and logistics, like transportation stuff, because those jobs are always in cubicles in the basement. Mm. And I understood, people they don't want to travel 2 hours a day. They want to stay and raise their kids in the suburbs or take care of elderly parents, whatever it is. So we went with the idea that, we would reduce our exposure square footage in primarily our headquarters in New York, Florida, Texas, and California. So we started negotiating a reduction of 15% with the REITs, primarily REITs, some private owners, but people we rent the space from, and the retail stores. Here we are, in September, so now 2 quarters have gone by. 55% of the staff will not come back, wow. Not 15. And if we make them, they'll just get another job. They don't want to come back. They don't want to. That's more than half. That's in in these private companies, and I think there's around 10,000 people, including the supply chain of these companies. There is a fundamental change in the way people don't want to go into a cubicle. In addition to that, some of my customers, like Bed Bath & Beyond, closed 200 stores. They're never reopening them. They're doing it all, curating it online, direct to consumers in suburban areas. I sell them product. Commercial real estate is fucked. That's what I think. I don't care if you're a movie theater or if, I'm not saying real estate, I said commercial real estate. There's law offices in Boston that have shut down 1/3 of their space. They've got their partners working from home. They don't want to come back in. So you don't, instead of a 4 cap, maybe it's going to be a 6 cap. You're going to lose 20%. That's why.
Do you think that's going to be remodeled to residential areas eventually? And
no, I think it's going to be climate-controlled storage. So what's going to happen is a lot of these buildings, Bed Bath & Beyond, for example, what I would think is going to happen, there's going to be a new asset class emerge on a conversion. So in other words, let's say you got to spend $1 million to convert an old Bed Bath & Beyond store into pick and pack climate controlled, and then rent it to Amazon, rent it to Shopify, rent it to Facebook, whatever. And so that you have these jurisdictions, including cloud kitchens, where people that live in these dense areas where these stores used to be have the benefit of having their product delivered to them within an hour or 2 hours. So that it'll get repurposed. But that's not good for you if you're the owner now, because you're going to have to sell that at a 7 or 8 cap or 9 cap, maybe 11 cap. And you bought it at a 3 cap. You're going to lose a shitload of money. And I don't want to be part of that dance. And so that's my, look, I may be wrong, but I don't think so.
Back to the inflation point. Sorry, because I interrupted you.
No
because
problem.
that was fascinating. But just I'd love to know what you use as your measure of inflation.
So right now, we are taking a combination of what you talked about, looking at our input costs, and at the same time, looking at what the government data is. I think inflation right now is running just under 3%. So combined across all sectors. And so when you're talking about making 21 basis points on cash, you're losing a lot of money each year, and which is why there's so much interest in just stable coins. Because right now, contracts for stable coins are running at anywhere, depending on duration, from 3.8 up to, I just wrote some contracts for 5.5 yesterday. So, I have to drag my compliance people screaming into this because nobody understands what USDC is. I mean, you can go online and read about it, but they just say, wait a second, how do we know this isn't going to go to zero? I said, how do you know that the US dollar isn't going to get slaughtered with inflation concerns? How do you know any fiat currency isn't going to have a problem? You simply don't know. But because we have no infrastructure to report those trades and those contracts and no way for the external auditor to do it, it's very, very hard. I had to hire 3 people just to do those contracts full time, to be able to say, okay, here's the contract, send it to the compliance department, show them when the duration is, show it to the auditor, set the infrastructure up so the reporting works within our internal organization. And I'm just one guy. Can you imagine how hard that is for massive institutions? They're not going to do it.
Where's the yield on those stable coins coming from?
It's basically, if you understand the loan of the asset, I mean, it's margin. It's basically a margin loan. That's what it is. That's the way you got to look at it. It's no different than you asking your prime broker to loan you money so that you can borrow 50% of your long purchase on a stock.
Who's the borrower, though?
Well, it's out there in the ether. There's a market for people that want to borrow stablecoin, that want to borrow Bitcoin, that want to borrow your tokens, and they pay for them. And they're using it to stake positions, and maybe they're using margin. In other words, if you think Bitcoin's going to have a big move up and you can use margin on it, maybe you simply borrow the coins and put 5x leverage on it. There's all kinds of trading like that going on. It's not illegal. It's risky. And the more volatility, you watch these contracts. When Bitcoin has a big up or down day, your yield can go up 25 basis points.
There's lots of people out who've been sounding the alarms about the global economy for a couple of years. I regularly speak to, you'll know Caitlin Long, I regularly speak to her, and another guy called Travis Kling, I don't know if you know him. Yeah, I've regularly spoken to those two over the last few years, and they've brought it up a lot. And people seem very jittery now, but you're plugged in to investors and institutions. Is that the same experience amongst people? Are people jittery about the global economy?
No.
They're not?
No, they're not. Actually, the economy here domestically is better than anything I've ever seen in my investment career. I mean, Let me give you the reason I think it's occurring. During the pandemic, first of all, we had all that stimulus, and we have, there's more maybe coming, we don't know. But let's take a business like Love Pop greeting cards, another one of my companies. They make greeting cards, okay? They're probably the fastest growing greeting card company in America. They're 3D greeting cards. They're laser carved in Vietnam. You can go to Hudson Yards right across the road here, and you'll find a Love Pop greeting card shop there. During the pandemic, all those shops were closed. And nobody buys greeting cards online. You buy it an emotional purchase. Oh, it's my granny's birthday. I'm going to buy her a card. It's my son's birthday. It's Easter. It's a holiday. And they're point of purchase emotional purchases in drugstores, train stations, and stores like Hudson Yards. That all goes to zero. The company did what all the successful companies did. They did the digital pivot. And they basically went online. Maybe they use Shopify, maybe they use something else, but they went out to the existing customers and says, hey, we're still in business. Do you want to buy direct from us? Not thinking that many would. Well, we were all very wrong. That company got up to 80% of its business back direct. Now, why you care about that is when you sell through retail, you make 50 cents on the dollar. When you sell direct to your customer, your margins can be past 90%. So you can lose half your business and make more cash flow. So today in my portfolio of companies, for the ones that survived, they are way ahead of forecast on cash flow, not on sales, but on free cash flow, because they've converted their business direct to consumer. The S&P did the same thing. Nike, in a matter of 5 months, did what they thought would take 6 years. They're 50% direct to consumer globally. That means Foot Locker means a lot less to them. Retailers a lot less to them, and their margins go way up. It's reflected in the S&P. So you're getting enhanced margins, enhanced cash flow, enhanced productivity, and this is the super bonus that nobody thought about. I mean, I couldn't even believe this would happen. It happened to me. We make 15% pre-tax in our portfolio when it's humming, and we get the weekly tear sheet on sales and free cash flow. 15% is the American dream. That's what you want. And what happened, we think we're going to make 17.5% this year. That's incredible. That's absolutely incredible, because we've cut our travel expenses, we've cut our retail space, we have cut all of that cost in having, employees in an office that now they work out of home. It's amazing.
Isn't that so? That's obviously a continual kind of changing, like, evolution of the economy. More business going online, and it's great for Nike, but maybe that's going to squeeze out some smaller retailers. So, who is this not good for? Because obviously this is great for the big companies who've got the money and the budgets to build out this impressive e-commerce infrastructure. But there must be some people getting squeezed.
Well, who's getting squeezed are operators that don't understand direct-to-consumer models, that don't know how to use social media, that don't know how to photograph their product, can't produce 59-second videos. Even Nike, these days I teach primarily graduating cohorts of engineers in places like MIT, Harvard, Temple, other colleges and universities, because a third of an engineering class will start a business, and I like to see the deals early. It's a good relationship I have. I always tell people, I used to, before this pandemic, if you're going to go and put yourself $80,000, $90,000, $100,000 of debt going through an education in a college, pick a career that you can actually get paid, so you can pay.
I was reading about a guy this week. He did it, and he's earning $40,000 a year.
Yeah. Okay. So, and I used to say, look, there's 3 disciplines that you should focus on. Number 1 is engineering. Number 2 is engineering. Number 3 is engineering. And if you have any spare time, do some engineering at night. And I would say, I love history, I love the arts, I think all that stuff is great, but you will starve to death if you do that. Now, I don't say that anymore, and I'll tell you why. My number 1 growing cost in my businesses today, videographers, editors, animators, story writers, I used to pay them nothing. They would beg for work. They would be lucky to make $15,000 a year and live in their parents' basements. That's not what's happening today. They are the most in-demand people, both corporately in the S&P 500 and in small business, because they're storytellers, and they know how to tell the story of a product or a service direct to consumer. The economy has changed. Now, those people graduating out of Tisch 2 blocks from here are some of the highly paid people in New York, because they're artists Who the fuck knew that would happen?
I'll tell my son he wants to come here and study at Parsons.
Well, I'm wrong. I'm telling you, I was wrong. And now, I mean, excuse my French, but I'm 100% wrong on that. And today I respect a great videographer, a great editor, a great storyteller, a good animator. I beg on my knees to hire them because they're in such demand. And so the economy has changed, and the losers are the ones that don't endorse that methodology of building a business direct to consumer, which is a global franchise now, not just domestic. And so that's why the economy is booming. That's why the stock market hits new highs every week almost, because it senses a new America, a digital 2.0 America.
There's a lot of people who disagree with that point.
Yeah, well, they're not living the life I'm living in terms of working with real entrepreneurs.
No, but they would say the S&P has continued to grow because the government had printed so much money.
Yes, there's the underlying liquidity, and there's truth to that as well. But, you look at earnings, every single print this year in every sector, 60, 70, 80%, depending on the sector, beat their numbers after they've been upgraded, in some cases twice. So you think about that. You beat your earnings, and the analysts say, oh, we got to upgrade the earnings. And then you beat it again. That's because you're enhancing your margin through direct consumer. You're enhancing your margin through cutting travel and entertainment costs, whatever you're doing.
There must be something like the airlines,
Oh, no, listen, the airlines are completely screwed.
Yeah, that's
but look, I'm saying there are losers.
Yeah, that's but that's what I was looking at. But who are the losers as well? Yeah,
that you've picked a good. I'll tell you the losers. Energy companies are losers because nobody wants to own their stock anymore. Airlines are completely screwed because they made the assumption that business travel would come back to what it was and it would come back quickly. It is never coming back to what it was. It'll take decades to get it back to what it was. If I own the company and you want to take a flight somewhere, you got to write online like a 5-page essay about why I'm going to make a 17% return on your trip, because you don't need to go. Mm-hmm. You can Zoom it, you can do Skype, you can do something else. You do not need to go there. And if you do need to go there, I got to get a return. It's going to cost me $5,000. How am I going to make $20,000 from your $5,000 trip? That's what I want to know. And if you don't have an answer, you're not going. And the reason I'm able to do that now is I know with certainty you can do your job because you just did it for the last 2 years without flying somewhere. So that's why it's really challenging for the business side. Now, the airlines say, great, we're going to do terrific work with consumers for holiday vacations. That's true. That's a shitty business. You fill up a tube with people at $79 and fly them to Disneyland, you make no money. And then you fly them back on the same ticket. That is a horribly shitty business. Yeah. Take United. They had an $8 billion deficit on their balance sheet, debt. I think they're over $20 billion now, and that was just 18 months ago. The balance sheet's upside down. I'm short that stock. I'm short all the airlines. They're not going to zero, but those stock prices are going down. The heartbreak of the Delta virus and the concern of new derivatives of these diseases every year are going to keep a lot of people out of, think about airlines. Some of them are saying you've got to be vaxxed, you've got to prove it. Like we're at this conference, you've got to show your card to get in here. And secondly, some airlines say, we don't care. You don't even, maybe you wear a mask, maybe you don't. So you're going to bifurcate that market into, here's a tube that you pay more to get into because everybody's vaxxed, and here's a death tube. You pay less because maybe half the people have the new variant of the virus. You don't know. And so I'm not getting in the death tube at any price. I'll try, if I'm going to fly, I'll go into the safe tube. But they're just cattle cars with people in them. I mean, I'm not trying to diss the airlines, but they're just buses. You got to think of it that way.
Well, listen, we've come right to the end of our time far too quickly. I could have probably chatted you for another.
Really enjoyed it.
We'll have to do it another time. Just a close out question, just because we are at a conference, and a lot of my listeners, a range of people with different careers, different jobs. A lot of them write to me, and most of them are just trying to create a good retirement for themselves and build up some
What's
cash.
wrong with that?
No, it's a great thing, but I would say a good closing question for someone like you is, if somebody is an early investor, what's the best bit of advice you've ever been given or you give to people who are just getting into the world of investing?
Well, diversification. But I will tell you, in the last, I've got a team of people that look at deals. And over the last 18 months, when we look at deals on Mondays at 10 o'clock, everything that's come in through the transom, we see a lot of stuff. And the ones that we've invested in, 60% are crypto or derivative of DeFi, because the growth potential in all of these opportunities. I should do a shout out to WonderFi. It just went public in the Canadian Neo Exchange 2 weeks ago. I've got another one I invested in with a guy named Jordan Freed. He's got Immutable Holdings. The ticker symbol will be HOLD. He owns the URL NFT.com. I met the guy when I'm launching a NFT in the watch space. I want to own that sector. I'm an insane watch collector. I know all the royal collectors. I know all the manufacturers.
What are you in there?
FP Journe, one of 17 in the world. And
I feel like a peasant in my Breitling.
So the point is, if I had an NFT for this watch, authenticated by FP Journe himself and the company, when it goes in the secondary market after my death, it'll be accredited. It won't be, because a lot of these watches get knocked off. And so when you start trading the secondary market, an important piece like a Patek, an Audemars Piguet, a Rolex maybe, you're going to find a real demand for authentication, and the chain is the way to do it. And I don't think anybody is in a better position than I am to make that happen.
Okay.
But for that investment, it led me to Jordan Freed because he owns NFT.com. I said, listen, I need that URL because I want to go NFT.com/watch.
Going to charge a lot of money for that URL.
So that URL is part of his portfolio, and that company also is scheduled to be listed, and I'm now a shareholder in that. So, there's lots of derivatives we can talk about in the future, but that's an example of a deal. Instead of investing in some other opportunity, that capital went to Jordan because I really like the growth potential. It's risky, I get it, but he's a smart guy, and I love his team, and he's now in my portfolio. And everybody that's talking to me about NFTs, I say, meet Jordan, because look what he's got. Looky here. He's got the URL, and everybody goes, oh, I need that URL. Of course you need that URL. And he's reserved all of the big brands. So there's nobody squatting on, NFT.com/Nike. He's got it, and he's not stupid. So I think, to me, that's the kind of thing I'm talking about. There's so much opportunity in this crypto and in decentralized finance that your capital goes there first. That's what's going on here. So my portfolio now is almost half of it in these kinds of startups. And now I'm building, because I'm involved with FTX, I'm using that platform for my compliance and Circle. And so I'm putting assets on there and bringing the whole compliance department screaming in, and those are the guys that are going to be winners because they have the capital to be able to build out the infrastructure that we talked about earlier. So,
right, they're telling us to wrap up.
Okay,
we're going to have to do this again sometime.
Yeah, it was great.
Really
enjoyed
more to talk about. Appreciate your time.
Yeah,
man.
You got it. Thanks. Ciao.
Ciao.